initiated. Hey, good evening, guys. KenLongTortoise Capital Cohort 1, small group coaching, November 4th, 2024. The last day of the previous millennium, staring into the abyss for whatever happens tomorrow during this crazy election. Who knows? I don't know. Hey, so what I want to do is my little work in progress, my check-in was had a strategy meeting for back testing with some of the boys, Phil and Griff, and then Bob Rourke. And I wanted to share with you the approach that we're following. Let me know when you can see that.
Not yet.
Should be up any second though.
Okay.
Yeah, so what we're going to do is among the first thing that we're going to do is we're going to go back 20 years. And the first thing that we're going to check is the effective market condition on future market returns. And what we're going to do is we're going to take a look at four different things. We're going to look at pure percent gain like we do in blended monthly rebalancing, the slope of of various regression lines. I'm going to monkey around with the system quality number Z-score of a particular look back period, and then the one I especially like, the MACD Z-score. So we're going to do something like this. First, we're going to check the effective SPY on a given day against the forward SPY. So I'm going to talk about percent gain first. So what I'm looking for is I'm looking for a 90-day period that was bad. And then I'm looking for a 30-day period that was good. So in my view, if I went back 120 days and found the price 120 days ago, and then the price 31 days ago, that would be 90 days. And what I would want to know is what's the percentage lost from 120 days to 31 days ago. So hopefully that's like minus 20%. And then I'm going to go to day 30 to day minus 1. And I'm going to say, what was the percent gain or lost in that 10-day period? What I'd like to see is a good positive number. So let's say that was plus 10%. The swing in performance is 30% because it lost 20% from here to here, and then it gained 10% from there to there. And maybe in a stack of symbols that it's 90-day and then it's 30-day loss. So I'm going to sort it by net difference between the longer term and the shorter term. And the greater that number, the more it looks like a huge sell-off and a nice recovery. So I'm going to take that as this kind of like what I'm calling the confirmed spring in a Four Seasons style approach, which is no different than the SSC on the intraday. Same fractal pattern. What I'm hoping to see is that a return to whatever that thing was, if that was 3, then maybe it sold off 3 units and then recovered 1, which is enough to make me believe in it, that it was a confirmed spring. And then if I frame it and I get the long, I could get 2 units of reward or something like that. Maybe not get the whole thing, but I could get at least 2 to 1. So that's nothing more than the SSC, but expressed as not a day trade and not a short-term swing trade and not the very, very long-term blended monthly rebalancing. Blended monthly rebalancing takes about 90 days of outperformance to move something to the top of the blended monthly rebalancing stack, which causes us to buy it. And then we're hoping on the extreme winners to keep winning. With this idea of the harsh sell-off and then the confirmed spring is finding things that used to be down in the bottom chunk and have now moved up into the yellow, from the red to the yellow or something like that. So I'm not sure what the best way to manage that is. Is it a 30-day or 90-day sell-off and a 30-day recovery? Is it a 90-day sell-off and a 10-day recovery? Is it a 30-day sell-off and a 5-day recovery? Could I use one of these as the long term and then use the 30 and 5 as a way to short term focus in closely, almost like a sniper? Well, the way we're going to do that at first is to simply go back 20 years in SPY. And then for every day of those 5,200 days, calculate what the price was 5, 10, 20, and 30 days forward look like. And then what I'm going to do is say, for example, if I take all 5,200 days and all the 30-day gains and then rank them from best to worst and find the average in the standard deviation, I can find the top 1/6 of those approximately. So approximately about 750 of the best 30-day movements. And then I can go backwards and find out, hey, what were the conditions on the 90-day loss and the 30-day forward, to see what's the best combination of these setups, long-term and short-term, so that I get the best possibility of the forward gains. And from that, we're going to discover what the market condition previous was on market condition forward. And then we're going to run that for all of the global indexes and the sector spiders, and then the individual stock components of the Dow 30, S&P 100, and S&P 500. So what we're going to find out is that when the market is in spring, summer, fall, or winter, that we could have some kind of expectation when the market is like that. What is its forward 5, 10, 20, and 30-day performances? And then which of the sectors, indexes, and stocks are performing the best in those 4 seasons? So I don't know whether I'm going to use the MACD histogram to come up with the seasons, or the simple percent rates of return of the sell-off and the gain in order to find this little spring moment. My spider sense is that the MACD histogram is going to be really good, but there's going to be a lot of overlap between just the raw percent gains and then the MACD. But we're going to find out for sure what that looks like. And what that's going to allow us to do is now have a bridge between the once a month calendar rebalancing and then the pattern-based swing trading, which usually lasts 3 to 5 days. So if this is once every 30 days, I make a decision. There is this, what we're calling position size, position trading, where I want to hold for 10 to 60 days. That is sort of in between blended monthly rebalancing and the swing. And it gets updated every day, whereas BMR only gets updated once a month. So it's going to be more like situational and adaptive trading. And we just want to look to see, we want to have some kind of play card that says, according to the 4 seasons, spring, summer, fall, and winter, or according to the Z-score of the MACD. Like, I believe that if the RL90, if I put an RL90 slope, when it's negative, the market is always negative until it turns. And once the RL90 turns, man, you got a nice long run for goodness. So it turns out that the slope of the 90 gives you your directional bias. So it may simply be that when the RL90 goes below -1 Z-score in terms of negative slope, that as soon as it comes back above +1, I can get long. So there's a long-term research project coming up in the next 6 weeks or so. I want to be able to say something intelligent between now and January on this whole topic of what is the effect of the S&P today on the forward holdings or on the forward performance of the S&P, the XL sector spiders, the other global indexes, and then the individual large components. Of interest, DIA is going to lose Intel and it's going to gain NVIDIA. So that's going to be good for NVIDIA. It's going to be really bad for Intel because there's a bunch of guys that have to own an Intel right now because it's a component of DIA, but very shortly won't have to own it for that reason. So a bunch of the automatic buying that goes into Intel is going to disappear, and they're about to get slaughtered. So that's good to know. Anyway, that's the research project that Phil and Griff and I are going to do. They're going to do it in EdgeRaider. I'm going to do it in Excel and also in probably some AI that I try to crank out. That may be something you're interested in as well, Cindy. Because eventually, whatever comes out of this, whatever combination of longer term indicators there are, my intention is to turn that into an EdgeRaider template, into an Excel sheet, but also into a TC2000 template to produce a daily report that becomes part of the bundle of indicators for people using TC2000. So you may want to get connected with us on that project. Okay.
Yeah, no, I'm happy to participate. Just one quick question. So is this really asking the same question that if I took SPY on different time frames, daily, 3-day, 9-day, monthly,
Yep.
and then I look at the MACD season. So if it's harsh winter now,
Yeah.
what is that what this is saying? That what is the future
Yeah.
expectation? Okay.
Exactly. Exactly. So if today if this is the 0 day, on the 0 day, if the market is in this condition, no matter, there was some back performance that created a specified condition. Okay, well, if it's in that condition today, where is it 5 days from now, 10 days from now, 20 days from now, and 30 days from now? So if I find the last 5,200 days and I know what every 30-day performance is, I could sort that and find the best 30-day performances and say, let me work backwards to see what were the conditions that 30 days later this thing was unbelievably good. Is there something common to those conditions? And I think we're going to find it's going to be harsh sell off and a verified, validated, confirmed spring. Because it's the biggest 10 days in the market, the best 10 days of all time were bounces off a bearish exhaustion. Those first huge bounces off the bottom get you well started. Whereas BMR waits until that thing has outperformed all the other peers. So you're in category A, it's already way ahead of all the other ones. Then and only then do you buy it. I want to catch that thing early after the turn and get advantage as it progresses from winter into spring into summer and then peaks and rolls into fall. I want to get it as it comes out of the winter into the spring. That's why I believe if I look at the MACD and here's the summer, fall, and now it goes into a harsh winter and now begins into the spring, somewhere in here, I want to be buying it. And now it turns into the summer here. I think that's the move that I want because we notice that the BMR really is starting to buy it right around here. whereas I want to get it in a confirmed spring, but also know that if this fails, I can be a collapsing dragon. So that's sort of like, that's an SSC fractal pattern, but on this 90-day look back period and 30 days forward. Whereas the SSC is an intraday pattern on 1 minute or 3 minute or 10-minute charts or something like that. So the concept is exactly the same, but it's getting a different part of the, and so I think of this as the four seasons because it looks like this, winter, spring, summer, fall, with these crosses of the 0 point. So like right now, I'm just using a 30 and a 10 with a 5-period smoothing. It may be that if we find that it's the 90 and the 10, I can just do a 90 and a 10. But we're going to find that out based on exhaustive review of the last 20 years. So that's going to be a massive research project. That's not dissimilar to what Juan Carlos was doing on the shorter term holding periods, I think. But you can see how there's a lot of different ways that I can measure market condition. I mean, I can even use the market classification strategy that I have, which is the, bull, sideways, and bear, volatile, normal, and quiet. In fact, that analysis over the last 20 years is how I came to my conclusion that for a 1-day forward holding period, any bull plus sideways quiet is good. Every bear is bad for tomorrow. And the sideways, volatile, and neutral were so close to 0 that there was no point in holding it. Well, I'm going to take the same kind of approach and then test all these other different methods of market classification, if you will, or symbol classification, and then not just use a 1-day look ahead, but 5, 10, 20, and 30, because that's the time period of longer term swing or position that I care about. And that's what money managers would like to do. They'd like to be able to get in early and then just let that thing cook. And if it gets 30 days of outperformance, chances are it's on its way. And then you don't have to get out at 30. You can just manage your exits. So that's what the research project going forward looks like. And now that we have a couple different legit backtesting platforms, we can do a little more work in that area. I usually carry so little risk overnight anyway that it hasn't been a high priority for me. But now that we got this IntelliQuant and guys interested more in the swing and positioning, I feel like I need to get off my ass and do that. So that's what we're going to do. Okay, let's go ahead and jump in with you guys, and let's get started with the check-in and your little spot reports.
Yeah, when you mentioned the overnight risk, it reminded me, did you see that news about the New York Stock Exchange planning on opening up 22-hour trading?
That's good. I hope they do that. That will simplify my life a lot. A lot. And they are doing that because everybody's taken their business to the futures markets and other exchanges. So the trading is still going on. It's just not happening on their stock exchange. So they're not getting any of the user fees. Why it took them this long to make that move, I don't know, but they're feeling the pressure of all the digital markets elsewhere. With the advent of single stock futures and global round the clock trading, why it took them till 2024 to sort that out, I don't know. They're about 15 years behind where I would have expected them to be.
Do you think the stocks will trade kind of like the index futures do, where there's still an open and a close that tend to regular trading hours? So when you don't want your at risk if you're trading a stock.
Well, what it does is it's going to there's going to be sort of like the currencies where there are very clear opens and closes as the different geographic sectors come online. Like when Dubai comes in and London comes in, there is furious activity for about an hour or 2 hours, and then it smooths out. But as more money gets robo traded and is traded on the basis of continuous signals and conditions based trading, you're going to see that the robots are going to dominate that even more. Now, the reason that's good for us is because we can detect rules that work, that are being used, and find ways to exploit those in a reliable way, just basically using statistics and conditions and compound critical states. That works even better without the artificial gyrations at the open and the close. Those two periods of abnormality just makes the middle of the day hard. And it makes you have much wider stops for swing trading because you have to account for the overnight news and how it's going to push things around in the aftermarket. Like right now, Palantir is up, let's see, almost 20% overnight. It closed at 41. It's trading at 48 right now, which means my PTIR is going to be up 40% in the morning if it holds this, which I'm hoping for. That would be nice. That would be a nice election day gift.